The requirement of risk in 5.1.1 meaning of financial stability.
Let's begin by understanding what financial stability means. Financial stability refers to a condition in which the financial system, comprising bank, financial market, and other institutions, operate effectively and smoothly even during period of stress. It means the system can handle economic shock, such as sudden drop in asset price or unexpected financial failures, without leading to panic or collapse. A stable system ensures that credit continues to flow, savings are protected, and businesses can operate without disruption. Ultimately, financial stability supports confidence among consumers and investors, which is essential for economic growth and national development.
5.1.1 Why regulation is needed.
Now, let's look at why regulation is essential. Banks are profit-driven, and without proper check, they may take on excessive risk to maximize return. This can lead to crises such as the 2008 global financial crisis, where regulation allowed banks to overextend themselves. Regulatory framework act like a safety net. They set rules for how much capital a bank must hold, what kind of investment it can make, and how it should manage risk. These rules protect not only the individual bank but also the broader economy. In short, regulation builds trust, ensure that bank act responsibility and customer money is safe.
Next, we move to 5.1.2 Financial structure of bank and impact of risk event on bank.
Next, let's discuss the financial structure of bank. This refers to how a bank organizes its finances, its assets, liabilities, and capital. Assets include things like loan given to customer, cash, and investment. Liabilities are the obligation the bank owns, such as deposit from customer or loan it has borrowed. The difference between asset and liability is known as capital. This is made up of shareholder equity and retained earnings. This capital is crucial, it acts as a buffer to absorb unexpected losses. The stronger the capital base, the more stable and resilient the bank is. Finally, let's understand how risk events impact banks. Banks are exposed to various types of risk every day. For example, credit risk occurs when borrowers fail to repay loan. Market risk happens when the value of financial asset drops due to change in interest rate, exchange rate, or stock price. Operational risk refers to a failures in internal system, people or processes like fraud or cybersecurity breaches. When these risks materialize, they can lead to financial losses. If a bank doesn't have enough capital or a well-structured balance sheet, these losses can severely damage or even collapse the institution. That's why risk management supported by regulation is so essential in modern banking.
Assalamualaikum and hi everyone. My name is Nur Kistina binti Muhammad Syaril Azhar and my matrix number is F1009. Now I explain the Basel regulatory framework by covering the requirements of Basel 1 until 4. Basel I was introduced in 1988 to create a common standard for measuring credit risk. It required banks to maintain a minimum capital ratio of 8% based on risk-weighted assets. It used a simple risk-weighting system and mainly applied to internationally active banks. Basel II improved risk sensitivity by introducing 3 pillars. The first pillar focused on credit, market, and operational risk with multiple calculation approaches. The second pillar was about regulatory review, and the third encouraged transparency and the discipline through disclosures. Basel II introduced 3 approaches for calculating minimum capital. For credit risk, banks can use standard approach based on external credit ratings or the internal rating-based approach where banks use their own estimates of risk. For market risk, they can use a standardized approach or develop their own value at risk model under the internal models approach. For operational risk, the options are the basic indicator, standardized or advanced measurement approach, depending on the bank's complexity and data availability. In response to the 2008 crisis, Basel III was introduced to strengthen the banking system. It required better quality capital, introduced new buffers, a leverage ratio to limit excessive borrowing, and liquidity rules to ensure short and long-term stability. Basel IV enhances consistency in capital calculation by making standardized approaches more risk-sensitive and introducing the 72.5% output floor. This prevents banks from underestimating risk using internal models and promotes fairness across the industry. That's all from me. Thank you.
My name is Nur Afika Huda binti Azmi and my metric number is F1001. I want to explain the capital adequacy rules apply to Islamic bank. Firstly, risk-sharing contract. Key Islamic finance instruments like mudarabah, profit sharing and musyarakah joint venture introduce different risk profile. These contracts do not involve interest payment and are based on profit and loss sharing, which means the risk exposure is shared between the bank and its customer. The net Sharia compliant risk. This is a unique consideration for Islamic bank. It refers to the risk of a financial product or transaction not complying with Islamic law. Bank must allocate capital to manage this risk and ensure ongoing Sharia oversight. Lastly, regulatory framework. The Islamic Financial Service Board provides specific guidance tailored to Islamic financial institutions. This guideline complement the base framework by accommodating the distinct characteristics of Islamic contract and operational model. Next, nature of the large exposure risk recruitment in Malaysian banks. Firstly, bank negates Malaysian guidelines. According to BIM, a bank's exposure to a single counterparty is limited to 25% of its totally capital base. This regulation applies to both conventional and Islamic banks. Secondly, purpose of the recruitment. This rule is designed to prevent systemic risk. If a bank becomes overly dependent on a single borrower or sector, the risk of significant losses increase in the event of default. The 25% cap help ensure that banks maintain the reserve portfolios, thereby protecting the bank and the financial system as a whole. The operation of a saving and investment account. Number one is saving accounts. These accounts commonly use contracts such as wadiah, safekeeping or card benevolent loan. In these structures, the bank holds the depositor's money in trust, while the bank may offer a discretionary gift hibah to the depositor. It is not an obligation and cannot be pre-agreed. Paying interest is prohibited under Sharia. Number two is investment account. These are typically based on mudarabah contracts, where the customer acts as the capital provider, Rab Amal, and the bank acts as the entrepreneur mudarib. The bank invests the fund and share the profit with the investor according to a pre-agreed ratio. Importantly, any financial loss is borne solely by the investor unless it results from the bank's misconduct.
Hi, Assalamualaikum. My name is Nur Samit Sofan and my track number is 01 Dkb4 F1026. This is the last part of our presentations, which is corporate governance. What is corporate governance? Corporate governance refers to the structure, rules and process that guide how companies are directed and controlled. It ensures that companies operate with transparency, accountability and responsibility. In Malaysia, corporate governance is crucial, especially in the financial sector, as it builds trust with investors, ensure compliance with laws and support the overall stability of economy. Good governance protects stakeholders and helps businesses grow sustainably in the long term. Next, we have a Malaysian Code on Corporate Governance. The Malaysian Code on Corporate Governance (MCCG) provides a framework for the best practices in corporate governance. The codes emphasize the importance of accountability, transparency, and ethical conduct. It is aimed at enhancing governance practices in public listed companies, ensuring they operate fairly and responsibly. Companies listed on Bursa Malaysia must follow the code or experience any deviations, ensuring they maintain high standards of governance to build trust with investors and stakeholders. After that, we go to principle of corporations governance. First, we have accountability. which is management is responsibility for their actions and decisions. Secondly, transparency, required clear, timely and accurate reporting of financial and operational activities. Thirdly, fairness, we have ensured that all stakeholders are treated equally, including stakeholders, employees and customers. Next, we have responsibility. Encourage companies to act responsibly towards stakeholders, societies, and environments. Lastly, we have independence. Ensure board members' independence from management to avoid conflict of interest and ensure unbiased decision making. And lastly, we have importance of corporate governance. Corporate governance is vital for maintaining investor confidence and the integrity of the financial system. By following good governance practices, company can minimize risks such as fraud, mismanagement, and conflict of interest. Strong corporate governance also supports sustainable business growth, improves decision making, and enhance a company's reputations. In financial sector, where trust and stability are crucial, investor corporation governance is a key to ensuring that companies operation ethically and responsibly.